Tariffs are essentially taxes. Governments impose these taxes on imported goods. When goods cross international borders, this tax applies. This makes imported items more expensive for buyers. The primary goal can be to protect domestic industries. It can also be a response in trade disagreements. These trade policies have far-reaching effects. They can change how businesses operate globally. Understanding tariffs is the first step. It helps us see the wider picture. The Indian IT sector is a global powerhouse. It primarily exports services, not physical goods. Think of software development or consulting services. These services are not usually subject to import tariffs. A tariff is typically on a product you can touch. So, direct tariffs on Indian software exports are uncommon. This might suggest the IT sector is safe. However, the reality is more complex than it seems. Indirect effects can be quite significant. We must look beyond the direct impact. The United States is a vital market for Indian IT. A large portion of India's IT revenue comes from US clients. These clients are spread across various American industries. They include banking, retail, manufacturing, and healthcare. Therefore, any economic shift in the US matters deeply. It directly influences the health of Indian IT firms. If US clients face trouble, Indian IT feels it. This dependency makes the sector vulnerable. It is vulnerable to changes in US economic policy. This includes the imposition of new tariffs. So while IT services themselves are not taxed at the border, the economic environment created by tariffs is crucial. If tariffs hurt US businesses, they spend less. This reduced spending can affect their IT budgets. Indian IT companies rely on this spending. This is where the indirect impact begins. It is a chain reaction. One action leads to another. The storm might be indirect, but its effects can be very real for India's tech giants. American companies, especially in manufacturing, feel tariffs. They might import raw materials like steel or aluminum, or they import components needed for their products. Tariffs on these imports increase their production costs. Higher costs mean lower profit margins for them. This financial pressure forces companies to make choices. They look for ways to save money. This often involves reviewing all expenditures. IT projects can be part of these reviews. New investments might be put on hold. Consider the US retail sector as another example. Many retail goods sold in the US are imported. Think of electronics, clothing, or household items. If tariffs are placed on these goods, prices rise. US consumers then have to pay more. This can lead to a decrease in consumer spending. If people buy less, retailers earn less. This directly impacts the retailer's financial health. Their ability to invest in new IT systems suffers. Upgrading e-commerce platforms might be delayed. When US companies face such financial pressures, their spending on IT services often comes under scrutiny. New IT projects might be postponed or scaled down. Existing contracts might be renegotiated for lower rates. The focus shifts from innovation to cost optimization. This is a natural response to economic uncertainty. Companies become more cautious with their investments. They prioritize essential operations over expansion. Indian IT firms provide many of these services, so they feel this reduction in client spending directly. For instance, a US automotive manufacturer. This company might be impacted by tariffs on imported parts. Their profit margins shrink due to higher costs. They might have planned a major IT system upgrade. This upgrade could improve their supply chain management. However, due to budget cuts, they delay this project. The Indian IT company slated for this project loses out. This shows the direct link. Tariffs on goods lead to less IT service demand. It is a ripple effect across industries and borders. The imposition of widespread tariffs carries a larger risk. It can contribute to a slowdown in the US economy. If many goods become more expensive, inflation can rise. Businesses might reduce investment due to uncertainty. Consumer confidence can also fall, leading to less spending. All these factors can slow down economic growth. A US economic slowdown would have global consequences. India's IT sector would not be immune. This is a significant concern for future planning. The global economy is deeply interconnected. An economic slowdown in the US means less business activity. This translates to lower demand for IT services. Companies of all sizes become more conservative. They cut back on discretionary spending. This includes many types of IT projects. Demand for new software applications might decrease. Projects for system integration could be postponed. Even spending on IT support and maintenance might be reviewed. This creates a challenging environment for IT providers. Growth forecasts for Indian IT could be affected. Some Indian IT services are closely linked to hardware. This includes services for installing new systems or maintaining complex hardware infrastructure for clients. It can also involve managing supply chains for IT hardware. If tariffs are imposed on hardware components, the cost of these components increases. This can make hardware-linked IT projects more expensive. It can also lead to delays in project execution. Sourcing components might become more difficult. This adds another layer of complexity for IT firms. Investor confidence is a key indicator. Recent trends in the stock market reflect these worries. For example, the Nifty IT index has seen drops. This indicates that investors are concerned. They are worried about the future earnings of IT companies, the uncertainty surrounding tariffs and U.S. economic health. These factors make investors cautious. A drop in the index reflects market sentiment. It signals potential challenges ahead for the sector. This market reaction is an important signal. The Indian IT industry has a history of resilience. It has faced numerous global challenges over decades: economic recessions, policy changes, and technological shifts. The sector has always found ways to adapt and grow. This current situation with US-India tariff tensions is another test, but it also presents an opportunity for strategic thinking. Innovation and agility are key strengths. These strengths will be vital now. Indian IT leaders are known for their foresight. They will be planning their responses carefully. One crucial strategy is market diversification. Reducing over-reliance on the US market is prudent. Indian IT companies can actively explore other regions. Europe offers significant opportunities for growth. The Asia-Pacific region, including Australia and Southeast Asia, is promising. Even markets in the Middle East and Africa are growing. Expanding into these new geographies can buffer risks. It helps create a more balanced client portfolio. This is a long-term strategy for stability. It ensures resilience against shocks in one market. Another approach is to focus on resilient service lines. Certain IT services remain in high demand. This is true even during economic uncertainties. Cloud computing services are one example. Cybersecurity is another critical area. Data analytics and artificial intelligence continue to grow. These services often help clients save costs, or they address essential business needs and risks. Focusing on these areas can ensure steady revenue streams. It is about offering value that clients cannot postpone. In conclusion, the tariff tensions create headwinds. The path ahead for Indian IT might have some turbulence. However, the sector's fundamental strengths remain strong: a talented workforce, cost competitiveness, and innovation. By diversifying markets and focusing on high-demand services, Indian IT companies can navigate this storm. They can adapt to the changing global trade landscape. The challenge is to turn uncertainty into opportunity. This will ensure continued growth and global leadership. The future, while complex, holds potential for those who adapt.